Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So normally when we looking for a dividend paying companies, we try to find dividend growth companies, and that means companies that are increasing the dividend year after year. And when companies increase their dividend, it actually shows that how healthy that business is. And I'm not talking about increasing less than 1% just to keep it there. I'm just talking about like companies that increase the dividends at least a double digits sometimes. And that's a very good sign for investors to know that the company's balance sheet is healthy, the company is making profit, and they are happy to share that profit with their investors and shareholders. That's really important. So what I'm going to do today is I'm going to share with you guys 5 companies that have increased their dividends in the month of April. Some of these companies are slightly overvalued at the moment. And of course, as always, if you're interested in any of these businesses, please always do your own research. As you can see, the portfolio is just basically ticking along. Today is actually mixed when it comes to the stock market. And of course, every single week, we're going to face the same issues moving forward until, of course, the interest rates come down, until the coast is completely clear when it comes to the interest rates, when it comes to wars, when it comes to recession, worries and all of these things. And for now, all we're going to do is keep investing every single week, dollar cost average as much as you can, and think about owning good quality companies for the long term. So before we start the video, I want you to like the video, please. That would be really, really genuinely helpful. And if you also can and join us on the Patreon account, it will cost you 15p per day if you can join us, where you will see all my buys and sells. You get access to the dividend trackers, you get access to the dividend calendar spreadsheet, you get the daily watch list that I share with the community, you get a private Discord where a lot of brothers are sharing very good practices. If you have any ETF, you've got the ETF tracker, and you've got Sharia compliant investing ebook to kind of help you understand the basics of what to look for when you're starting, especially when you're starting your Sharia compliant investing journey, if you like. Right, let's get started. And the first thing we're going to do is look at these usual things that we normally look for, but this time we're focusing more on the latest increase. Right, I don't want to make the video any longer than it needs to be. So the first company we're looking at today, and that company is Procter Hannifin Corporation, 71.1 billion market cap. It has a narrow economic price right now is $553 per share. Dividend yield of 1.2. Payout ratio only 24%. So that means the company can still, it has a room to increase that dividend. And the latest increase was double digits, 10%, which is really good to see. And the 5-year dividend growth rate is actually 15%, which is really good. The dividend streak of basically 67 years of increase in that dividend, which is absolutely huge. And that means the company is a dividend king. So dividend kings are stock companies that increase the dividend 50 plus years. Dividend aristocrats are 25 years or more. The annual payout you will get is $6.52. Safety 94%. The 5-year revenue compounding annual growth rate of 6%, which is decent. And the EPS is 19%, which is quite nice to see. Profit margin 13%, return on equity 25%, and return on invested capital is 16%. $2.8 billion of free cash flow. Total return in the last 10 years, we're looking at about 17%. Growth estimate next year is 8%. Growth estimate for the next 5 years per annum is about 11%. 32% premium right now. $417 per share is where they think the price should be, according to Morningstar. Now, looking at the company in terms of earnings expectation is moving forward. As you can see here, in terms of EPS, we're expecting double digits next year. So this year, then about 8%, then about 9%, 8%, and so on. When it comes to revenue, that 4%, 5% mark, if you like. Now, just to quickly show you, in fact, the ratings from Wall Street, it is actually 12 strong buys, 3 buys, 7 holds, 1 sell. And it's about 4-5% upside from where we are right now. So 579. But like I've always said to you guys, I like Morningstar valuations because that gives me basically sort of a margin of safety. On top of that, I always like to add another 5 to 10%, if not 15% margin of safety. Next one we're looking at is Grainger. We've talked about this company a while ago. This is probably one of the most expensive companies that I've seen in the stock market. Even after it came back from COVID, it was still expensive. I have never seen this company trade lower than that. $45 billion market cap, narrow economic moat, $930 per share, about 1% dividend yield, payout ratio 20%, and the latest increase was also 10%. The 5-year growth rate, we're looking at about 6%, dividend streak of 52 years, so another dividend king. Annual payout right now is $8.20, safety 99%, 5-year revenue growth rate, we're looking at about 8%, and in EPS we're looking at about 25%. Profit margin almost 11%, return on equity 61%, and return on invested capital of 41%, which is quite nice to see. $1.7 billion of free cash flow, total return the last 10 years about 15%. Growth estimate next year they're expecting about 10%, then after that 28% every single year per annum. 71% premium, like I said, one of the most expensive companies that I've seen, and $550 per share is where they think the price should be. And looking at the earnings expectations moving forward, we can see about 7%, 9%, 6%, 7% there, 5% in terms of revenue, about 6% there, about 7%. So nothing huge basically there. But in terms of ratings, let's see what Wall Street's saying. 2 strong buys, no buys, 13 holds, 1 sell, and 1 strong sell. So as you can see here, it's about 2% upside from where we are. But then again, that is still, for me, it is too expensive, so I wouldn't touch it. Next company we're looking at today is J&J. J&J has actually just given us about 4% raise recently. So the company, you know, J&J, I've talked about it so many times. $352 billion market cap, wide economic moat, $156 per share. So it's been trading below 150 for quite some time now, which is basically nice to see for the first time. Dividend yield of 3.4, payout ratio 45%, and 4%, like I said. And again, this is too low for J&J. Okay, the J&J used to increase the dividends almost double digits every single year, those back in the days. But right now, it's not becoming. It's kind of last couple of years, it's been a little bit disappointing. And I'm kind of, honestly, it used to be one of my favorite companies. It has done absolutely nothing for me this year. So I'm definitely considering getting rid of this company and potentially add another one that is way undervalued, because this is only 9%. The growth, unless the growth, I'll show you in the expectations in a second, you will see what I'm talking about. So about 4% in terms of the latest increase, 5-year growth rate of 6% only, 61 years of increasing that dividend. Another dividend king, $4.96, safety 99%. The last 5 years, basically in terms of revenue side of it, is only 4%, which again is disappointing. 6% in terms of EPS, profit margin. I don't expect much from this company, but at least 7-8% in terms of revenue. But that hasn't happened. Profit margin 21%, return on equity we're looking at about 18%, on return on invested capital 24%, $17.7 billion for free cash flow. This is one of the companies that are A+ rated. I think it is basically one of the highest rated companies when it comes to, you know, those credit ratings, and it has a better rating than the United States. Basically, this company and Microsoft are the only 2 companies that are rated that high. So in terms of the quality of the business, there's no doubt, but recently it has been a little bit disappointing, especially with dividends and in terms of revenue growth. Total return in the last 10 years, we're looking at about 6%. That's really disappointing. A growth estimate next year about 3%. After that, 5% only, which is again not great. Morningstar saying about 9% discounted right now, $164 per share. So if we go in here and type J&J, what you will see is in terms of earnings expectations, you can see 7% this year, but then 3%, 4% after that, which is what I kind of expected. But because they now got rid of the consumer bit, I thought this probably would go slightly higher. So let's see what is in the pipeline in terms of drugs and so on. But 3%, 4%, 2%, 3%, 3%. If the dividend increase was there as well as this, then I would have taken. But right now, it seems a little bit disappointed. So I'm definitely looking at this one in the next few weeks. Growth as basically in terms of Wall Street analysts, basically we're looking at about 7 strong buys, 4 buys, and holds is about 11. Wow. Okay, so you can see about 11% upside from where basically they think it should be. So $173 per share. That is very bullish in this. So these Wall Street analysts, I'm not sure. As always, they are, you know, over bullish for majority of these companies. So we'll see what happens. Anyway, so I'll let you know what I decide, inshallah. As always, I'll be honest and transparent when it comes to that. ODS Worldwide is the next one. 37.3 billion market cap, wide economic moat, $39 $93 per share right now, 1.7 dividend yield. Payout ratio is only 36%, which is actually quite good. Latest increase was 15%, so that is really good. They have not been increasing that long, so that information is not available. Dividend streak is only 3 years. Annual payout $1.56, 60% in terms of safety, so it's below that 61% that we say is safe. Okay, the 5-year growth in terms of revenue 3%, then 13% for EPS, profit margin about 10%, return on equity about 19%, 89% when it comes to return on invested capital, which is absolutely huge. Free cash flow, I want to double check this. Yeah, there you have it, 89% when it comes to that. That's absolutely fine. So $101.3 billion of free cash flow. Total return the last 10 years about 8%. Growth estimate next year 10%, 11% after that. Fairly value right now $93 per share is where they think the price should be. And now looking at the earnings expectations moving forward, about 10% every single year, or 9% for the next 3 years. Then about 3-4% when it comes to revenue side of it. So nothing huge there. In terms of ratings, if we look at Wall Street, 5 strong buys, 2 buys, 9 holds and 1 sell. That's about 5% upside from where we are, which is good. Now, in terms of next company, we're looking at Procter Gamble, another company that I own, which is also a dividend king. I did not select this, by the way. I think just happened. But yeah, this one is not, of course, dividend king. But 381 billion market cap, wide economic around $161 per share, dividend yield of 2.5, payout ratio 57. It's gone up a little bit, so it would be nicer to see that come down. Latest increase was 7%, so decent. I prefer that over, you know, these 4% here, 6% in the last basically 5 years. Growth estimate, basic dividend streak of 67 years. So they've paid more, well, similar to Parker and Hannifin basically. $4.03 is what you will get. 99% safety. In terms of the growth revenue side is about 4%. In terms of EPS, 39%. Wow. Okay, I need to check that. We need to check that profitability. So EPS, no, we're looking for growth. So in terms of EPS, okay, so yeah, okay, that's interesting. Profit margin about 17%, almost 18%. Return on equity, we're looking about 31%. Return on invested capital 24%, $16 billion of free cash flow. Total return in the last 10 years, we're looking about 9%. Growth estimate next year 6%, 7% in the following 5 years. 13% basically premium right now. $143 per share is where they think the price should be. Now going back here, earnings expectations for the next couple of years, 11%, 6%, 7%. That's decent. That's what I would like to see. Okay. 2%, 3%, 4%, that I can expect that. From revenue side of it, I expect about that 4-5%, up to 7%, possibly 10%, and this is decent. Okay, now ratings, as always, Wall Street is saying it's a buy. 12 strong buys, 5 buys, 8 holds, 1 sell. And in terms of where we are now, about 5-6% upside from where we are. $170 per share is where they think the price should be. Now, Sharia compliance side of things, as you can see, pause the video, have a look at it. No issues with any of these companies. In my opinion, this comes from Zoya, so based on what they what's on the app right now. So there you have it. That's the 5 companies I wanted to share with you guys. As always, like I said to you, it takes a lot of time and effort to put these videos together to kind of show you some of the companies out there, good or bad. I'm going to share with you guys. Of course, you make your decisions. You're entitled to your opinion. Do what you need to do. It's your investment, it's your money in the end of the day, but I will just share my, my thoughts on these companies and what I think. I'll give you some information, and do what you do with it is entirely up to you. So if you can join us on the Patreon, that will be absolutely amazing, if that will help the channel. And if you can't do that, just like the video, subscribe and share with your families and friends if you find it any benefit, inshallah. Have a wonderful day. Assalamu Alaikum.